In 2019, WeWork was said to be worth $47 billion. 6 weeks after revealing its financial details to the public, that number collapsed. Investors pulled back. The company's public launch was cancelled, and its CEO, Adam Neumann, was forced out. How does a company rise that fast and fall that fast? To understand that, you have to look at both the man and the structure he built. Adam Neumann did not present WeWork as a real estate company. He spoke about community building, about changing how the world works. He convinced investors that WeWork was a technology platform, not just office space. That framing mattered. Technology companies are valued for future potential. Real estate companies are valued for steady income. By positioning WeWork as tech, he unlocked enormous funding. Money flowed in, expansion accelerated, valuations climbed. By early 2019, private investors valued the company at $47 billion. But underneath the excitement, the structure told a different story. WeWork signed long-term leases on entire buildings, sometimes 20 to 30 years. Those were fixed commitments, large, unavoidable monthly payments. Then it rented desks and offices short-term. Members could leave with little notice. That created a structural imbalance: long-term obligations, short-term revenue. As long as new members kept joining, the imbalance was manageable. But the company was already losing billions of dollars each year. It was not generating steady profits. It was surviving on continuous investor funding. Growth masked fragility. Expansion hid risk. Neumann also maintained extraordinary control. He held special voting shares. He could outvote other investors. He leased properties he personally owned back to the company. He sold the We trademark to the company for millions. Individually, each decision could be defended. Together, they signaled weak internal restraints. A leadership that is not challenged only places the company on the brink of collapse. In 2019, WeWork attempted to go public. That meant publishing its full financial records. Private investors often focus on vision. Public investors focus on numbers. When the documents were released, the analysts saw billions in annual losses, massive long-term lease commitments, no clear path to sustainable profits, and a governance structure heavily centered around one individual. Confidence shifted quickly. Within weeks, the company's estimated worth dropped sharply. The public offering was withdrawn. Neumann stepped down. The momentum reversed. The speed of the collapse was structural. The company depended on three things: continuous funding, continuous growth, continuous belief. When belief weakened, funding slowed. When funding slowed, growth stalled. But the lease obligations remained. The business did not have enough stable income to support its commitments without constant expansion. That is what turned pressure into crisis. In 2023, WeWork filed for bankruptcy, not because office demand vanished, but because the structure required uninterrupted confidence to survive. And once that confidence broke, the math no longer worked. WeWork's failure was not just about ego, and it was not just about bad timing. It was the combination of a fragile financial structure, aggressive expansion funded by outside capital, and leadership with limited internal restraints. When growth is not built on durable fundamentals, collapse can be sudden. And when control is centered on one person, correction becomes difficult and often too late. collapse becomes inevitable. That is how a $47 billion company became a bankruptcy study case. If you are interested in how executive decisions shape outcomes, subscribe to The Executive. New analysis every week.